Hi, welcome to the first episode of the Scaling Alpha podcast. Today I'm joined by Ross Williams, the co-founder and portfolio manager and chief investment officer at Deer Lake Strategic Management, which he co-founded after nearly 20 years as a systematic derivatives portfolio manager at Citigroup and Walleye Capital. Deer Lake is a Minneapolis-based hedge fund that applies systematic S&P 500 index option strategy to capitalize on volatility, built specifically for boutique investment advisors and sophisticated investors. Ross, over to you. Take us through your background and how you got to where you are today.
Yeah, thanks for having me on, and I'm really excited to share about my background and the company we've built. So it was a long time in the process in building it, but it was very intentional from the beginning of my career. I knew what I wanted to do. But to begin the journey of launching a hedge fund, you just can't do it on day one out of college. So I needed to gain the investment ability and knowledge and skill set of how to actually manage risk and run large amounts of capital for institutions. So yes, I started my career working for actually a smaller group that was ultimately bought by Citigroup in 2004. I worked for a company called Knight Financial Products. It's an options market maker. I worked on the Pacific Stock Exchange, our options exchange out in San Francisco. So I actually worked there in college because I knew that that's what I wanted to do. Began the journey by I was able to get on the options floor and walk around and hand out my resumes to various different trading groups. I knew I wanted to use my brain and my knowledge to make money. Yep. I was not interested in selling anything at all and being a salesperson. So a lot of the easy entry into the investment management industry is by working for a stockbroker or an investment advisor, being an assistant to them. And, it's a very important part of the financial landscape especially for the average everyday American that has a stockbroker or an investment advisor. But that's not the lane that I wanted to sit in. I wanted to be part of the money-making process and using my ability to actually make money. And so that's where I began my journey as an options market maker. And frankly, I had no idea what that was when I started. I just knew that I was working for a trading group. And
I kind of equate kind of the battles that you've gone through actually doing it. You don't jump into it out of college. You got to gain the experience. It's kind of like if you've ever done boxing or martial arts. You can practice the moves all you want, but until you actually start sparring, you never know what's going to come at you. And so that experience is kind of your battle testing, where you see you start learning in real time all the things you didn't know, you don't know. And it's one of the things it looks like that you learned through the process is that volatility is an informational asset rather than noise. How did you develop that kind of way of thinking? And how did that affect kind of how you ran your business and how you managed money once you came to that realization?
Yeah. Well, as an options market maker and an options trader, whether running a volatility arbitrage book or a market making business, you're not necessarily concerned on where the stock is going to go. You're concerned in pricing based upon, amongst other things, the volatility of the underlying asset, because that is one of the main components that goes into the value of the option that you're either buying or selling. And so you have to have a good understanding of how much something is going to move based upon whether you're willing to buy it or sell it. And so it's looking at volatility surfaces is really the key component of trading options. And it's in that I built my entire career looking at volatility structures to make money. And it's something that the everyday investor or trader doesn't necessarily think about or have a good understanding on because they haven't gone through the ups and downs of making bad trades based upon the volatility of an asset. And so when you've done that for a long time, you know that you can look at the volatility structures within the market and then gain an idea of, well, you have your own opinion on is this a good buy or a good sale, but it also lets you know where the option's priced of what the marketplace is actually thinking. So it's amalgamating all the information of people's demand to buy and sell these options. And if they're relatively liquid, you can get a good idea of what the marketplace is thinking. And if it's an illiquid equity product or a smaller security that people aren't looking at that much, but there becomes a large demand to either buy or sell options, you can get an idea without having to know who specifically is interested in buying or selling them, but there's a change of opinion and they're delivering that information to the marketplace by pushing the options pricings up and down.
That makes sense. Well, it sounds like you mentioned Citigroup, Walleye, you're the first firm that you worked for as well, and the Pacific Stock Exchange. I mean, how long was that portion of your career? 20 plus years? And what lessons did you learn beyond just the honing of an investment strategy at those large firms?
So I worked for Citigroup from 2001 through the first quarter of 2021, and then I was at Walleye directly after that through 2023. Mm-hmm. And outside of the actual pricing of options and the real general role that I had was as a trader, market maker, portfolio manager. You needed to not only look at your trading decisions, but ultimately how would you establish a book and a portfolio that was that you could manage within the constructs of a large organization. So you might have a great idea and you might have an awesome portfolio that you've built, but unless somebody that is higher up from you believes in your idea and your portfolio, you might not be able to carry those positions in the size that you want. So you have to manage your business in a way that can exist within the business ecosystem that you're in. So if you're forced in and out of positions, it's extremely costly for you personally and professionally for your track record. So, and any trader that's been in the business for a long time has been in positions where you get tapped on the shoulder, as we say, and by your manager walking over to your desk and saying, "All right, this is too big. You need to close it." And it's not only a great learning lesson, but it's not very fun professionally to deal with. Mm-hmm. And so it's just figuring out how to not land yourself in those positions, because ultimately, in the way we're running our current business, is you always want to manage your risk in the way that you can keep it in all market environments, because you can't be forced to close, because being forced to close positions breaks your model of how you actually, and your expectations of what you would see the potential for your trades if you're forced to close it.
I can imagine that was a big input to wanting to start your own firm. Were there other inputs, other things beyond just wanting to run your strategy the way you want to run it, that caused you to kind of leave the big corporate world and start something on your own with your partner?
Well, I kind of didn't quite get into it when I was talking about my background, but when I was in college, I knew that I wanted to run my own business. And after, like you mentioned, working for large corporations for over 2 decades, it was time. And I'm 47 now, well, I guess next week, but I couldn't really do it at 57.
Yeah.
Yeah. And I couldn't do it at 37, right?
Yep.
Because I was too green, and not necessarily too green, but there was still plenty of opportunity in that space for me, and relatively comfortable. But at the point of my mid 40s, I guess I was really decided to make the jump in 2024, because I took some time off after I left Walleye, and the idea of building something very exciting with the skills that I've gained, and then it was time to learn something new as well, which is not only being a portfolio manager and a trader, but a small business owner. And I talk to fund managers that they're running over $1 billion, and it's still a small business for them. And you don't have that many people working for you, but learning how to run the small business in all the facets has been a wonderful learning opportunity to learn something new.
That's amazing. Yeah, I mean, oftentimes we're forced to grow in ways that we never thought possible, and I've found running a small business has forced me to grow in so many different ways. So it's actually a very rewarding experience. So getting to your strategy, right? You're capitalizing on volatility extremes through a systematic S&P 500 kind of options derivatives approach, right? You mentioned that at your previous positions, you have a manager come tap you on the shoulder, close that big position. Really, in a lot of ways, it's kind of fear of what could happen, fear of the downside, volatility, things happening in the market that are causing you'd have to, in that case, make trades that you wouldn't have made. How do you deal with that fear when you're managing your own money and everything kind of accrues to you and your partner? Every decision you have to live with ultimately as the arbiter of that, right? How do you stick to your discipline in the kind of rocky times and fear driven environments?
Yeah, and that's a great question. And one of the primary components of our systematic strategy is I'm a person, and so is my co-manager, and so are all our investors. However, and I do feel emotion, and so does my co-manager. However, we have taken emotion out of the equation. So no matter how fearful I am or worried or uncertain I am in certain moments, it doesn't matter because our strategy is predefined and there's no human element to making the trading decisions. It's been our systematic strategy is based upon over a decade of mathematical data, and we lean on that to tell us what we're going to do in certain times. So it doesn't matter if I think a trade is good or bad, if it's time to close or it's time to add. But another primary component of doing that is you have to make sure that you're well capitalized enough where you can carry the positions are and also have communicated effectively to your stakeholders what's going to happen in different times and what are potentials for down draws and what do those moments look like. So if you communicate that effectively to your investors and to your internal stakeholders as well, you always know what you're going to be doing, but it's just you have to ultimately have a very, very well developed plan for all market environments where the game does change, where there are volatility events in the marketplace, people are panicked and scared and forced to make costly decisions. And so ideally, we are capitalized and risk managed effectively where we will not have to be forced to trade out of positions because of market events.
Related to this, I've noticed that you've written about the expensive cost of market fear and what you call the overlooked right tail. Tell me more about that and how you look at it differently than maybe other investors would look at it.
Yeah, well, I mean,
it's price risk.
The right tail specifically, what I was speaking of in that time is the upside volatility, and of not only in moments of market fear, people are out there hedging for downside risk by buying puts and selling upside calls, and in moments where people are either afraid of something bad's going to happen or something bad has already happened that's caused a down draw within the equity markets, people stop looking at, well, perhaps there is a statistical advantage in going out instead of selling calls, buying them. And that is what I'm speaking about in those moments. And I believe that I put that piece out right in, I think in March. I know I spoke with investors about that then, at least. And that was very much proven within the marketplaces that calls were massively underpriced. And that's a great opportunity to think differently than where the marketplace is. But if you're not well capitalized enough, you can't go out out and buy calls. And so that is more or less, not a recommendation, but the idea of people overlooking that instead of maybe buying more stock, perhaps one could look at the out of the money call options as value and in great opportunity because people are selling too many of them and they've pushed the prices of them down.
So basically, they're overpaying for downside protection. Essentially, is what we're talking about here, right?
I mean, to say that they're overpaying, right? I mean, if would they feel that they were over if the S&P was down 10% in March or at a certain moment, and they were buying puts and selling calls, and then there was another 10% drawdown within the market? Well, they wouldn't have overpaid in those moments, but pricing gets to a point where, I mean, sure, you could, if you need to hedge downside risk, you could buy more puts if you need to or you expect a further down draw. However, you can also buy calls as well. But in those markets where people are theoretically could be overpaying because with the skew structure in the option space that they've put, the people are just, it's pushing puts higher and calls are forced cheaper and cheaper, and as the skew structure moves, the right tail becomes dramatically cheaper than the left.
Yeah, yeah, that creates a great opportunity for you and your fund. It sounds like.
Yeah. I mean, it was, though that's what, but the whole idea is to be capitalized well enough where you can actually do it in those moments, because you can't have a great idea if you're already tapped out on your risk.
Yep. So you have to plan for that opportunity ahead of time for that market occurrence.
Correct.
Yep.
And
Got it.
And perhaps when there's not a lot of market opportunity, not being forced to carry large positions because their opportunity is not that great, and you might be able to generate greater returns in those moments where the market there isn't a lot of opportunity by forcing your hand. But when the rules change, and they can change overnight, you can't actually do your job because you don't have unlimited capital.
So are you, from the component is, are you always keeping some sort of cash reserve where some of the assets in cash to take advantage of moments that pop up like this?
Well, it doesn't. I mean, one, you could manage you could keep a cash reserve, but it's really based upon an options portfolios across the marketplace, whether you're at a bank, a large hedge fund, a small hedge fund, or an individual investor, are based upon portfolio margin limits that the options clearing corporation sets. And so if you have, $1 million in a retail brokerage account and you have portfolio margin on it, it will look and you will be able to, even if you're not borrowing money, you're borrowing risk. And it's the idea of keeping portfolio margins such that you don't want to be running that at a really high level. So you can't, if you need to increase position sizing, if you're always running at 80% of your available risk, and it's really the risk that you're taking, because you're not borrowing money, you're borrowing risk. And because you could be using 80% of your portfolio margin, but have no interest expense. It's just the broker is not going to let you increase your position sizing more, because they could look at the potential moves and the costs. So if the market moved a certain degree, then your available capital in your account would have declined so much. So it's just, running your
managing
margin.
that risk.
Yeah. And, we try, and we're, keeping it in the, well below 50% of that available, well below in low volatility environments where there's just not a great idea for us. So we want to be able to trade bigger and press the gas pedal when we need to.
Got it. So one of the things I read about that is that Deer Lake is built for like boutique advisors and not necessarily for institutions. What do you mean by that? And what makes what Deer Lake is doing in your fund and what you're trying to achieve a good fit for boutique advisors and working with them closely?
Well, specifically with the investment strategy aside, what we wanted to address, as far as running a business, is you have to have a target market. And obviously we would take all interested parties who wanted to, be partners with us or investors. However, that's not realistic. You have to focus on one thing or one or two things. And the boutique investment advisors are a relatively underserved portion in the investment community that's dominated by large banks and large institutions, and they're also running their small business as well. And it might be quite lucrative for them, but it's still a 1 or 2 man or 3 man shop, and it's far easier for us to have conversations with people that will not only be interested in what we're doing, but also a decision maker. Because if you're talking to a large group, you might talk to somebody who really loves your product, but ultimately they're not a decision maker. And that person who is the decision maker does not care because that's work for them. And so we're focusing on a portion of the marketplace where we can be a real value add to them. And that is and it's an available avenue for us as well to get in and speak with people that aren't being called on by the large banks.
Yeah, I think I think it's extremely interesting. A lot of, not speaking about your strategy in particular, but in general, there could be a market perception with normal investors or advisors that hedge funds are inherently more risky than other types of investment products. But the actual idea of hedging and figuring out how to hedge your risk and generate a return that is risk adjusted better than the benchmarks. That's generally what hedge funds are trying to do. But to some extent, the institutions grab up all the capacity for a lot of funds out there, and having a strategy to serve those advisors and their clients, it's very interesting, and I think it could be an untapped market. As we all know, you have to have the right product that fits the profile, the risk profile, and the ability to invest from accredited and qualified investors, and those exist in that channel. I'll be interested to catch up with you one day, maybe up on a follow-up podcast, to see how that strategy is going. But it's great. You founded the company with Nathan. I'm pronouncing it right. As it Owl? All. And he seems to have some metals trading and derivative background as well. How do you two complement each other? How are you different? How does the alliance of you two make the firm stronger?
Well, what was very helpful in the decision to work together to launch the company was that we worked together for 15 years.
Okay.
At Citigroup. And we didn't manage the same portfolios together, but we sat right next to each other. And the trading options, whether you're trading it on gold or corn or oil or Microsoft or the S&P 500, it's all based upon the same ideas. The foundation being that volatility of the underlying asset. And so we have a very strong professional understanding of both of our skills, and watched each other had great success in what we were doing. And also, we're close friends, which that helps as well, obviously, in managing a business, and we work really well together. He is a very skilled and competent mathematician, and that is, I lean on him a lot for the analytics that we're using and the back testing of trading strategies, etc., and forward-looking scenario analysis of how, yes, we do have our systematic trading plan, but we're also concerned as, okay, well, this is what we're doing. What do the next 3 to 6 months potentially look like? And then we can have conversations with people that are existing investors or potential, partners of, okay, this is what's happening now. What do we think the next 3 to 6 months is, potentially going to look like? And he does a lot of that analysis, which is, he's fantastic at it, and his math is never wrong. Well,
you're a quantitative hedge fund. You have to have amazing analytical skills to do well, and you got to have extremely quality data, right, to run your strategies by. So that's fantastic. So kind of moving on to a different talk track, the world has been changing very rapidly, especially the last couple of years, with the advent of, quote, AI. Right. Being a systematic trader, systematic investment firm, is AI changing how you do things? Tell me more.
Yeah, I mean, AI obviously is changing the landscape for most businesses. I think that you have to be employing it because it's a great tool, and I think it's extremely powerful. As a small business, it's a wonderful value add for us because we can employ AI tools for research, scenario analysis within the investment landscape it saves us the need for having one or two other analysts on staff, because we can do a day or two's worth of work in a morning, and it's very valuable at examining data sets. And that's from an investment point of view, we do not use it for making investment decisions or trading, but it's really for analysis of data, and that would be from the investment perspective. Now, from the small business perspective, it's extremely helpful as well, as for compliance purposes, for legal purposes, and our attorneys love it because I can I can do a little work on my own and be my own paralegal, that I can just shoot it to them and they say this is okay, and it saves me money, and they don't have to charge a couple $1,000 to, and they'll just give it a quick review and say, yeah, that's great, and then not bill me because they didn't want to do that work anyway.
It's low level work. And when it comes
exactly.
to the kind of the systematic analysis, not the decision making from the scenario analysis approach of how AI can help you, I can imagine you're not using basic LLM tools, which are notoriously not the greatest at complex math. Are there specialized tools? I mean, maybe you're not even using LLMs, but maybe you're using neural networks, some of the more traditional approaches. Tell me more.
I mean, anything we're using is really not. It's all off the shelf. So
it is. Okay.
It's not. We don't need anything bespoke enough, being that we're not making any investment decisions with it.
Yep.
But to just the general platforms that most people are using, and because we already have our models built. Before. I mean, our model was built in 2021. So the AI that's not that long ago, but AI certainly would have been helpful in that process. It saved, because it took many months to do.
Yep.
And I imagine that the process would have been probably days with it, and would have been helpful. But at the same time, we're 1,000% certain because we did it ourselves that it's right.
Yep.
And so you don't need to go back and look or have the questions of, is this AI tool, is it just pleasing you by giving you the answer that you want, or is because sometimes that's my one complaint about AI tools is they rarely tell you that you're wrong, and and sometimes you're using it to be told that this isn't the right, you're not thinking about this right, you need to look at a different spot. And so we still lean a lot on the human element.
Interesting, very, very interesting. I'd love to unpack that with you a little bit separately from the podcast, but it's I kind of went to this podcast not certain how quants use LLMs, right, or use the kind of the broad-based tools. We do know that like quants often use some of the kind of the other predecessor technologies to LLMs that to do back testing and things like that. But it's interesting. I'd love to learn more.
And I mean, we being that as a market maker, in interacting with high frequency technology, mid latency technology, doing that for that portion of the financial marketplace has been using automated trading mechanisms and machine learning for decades, and so we had automated trading mechanisms in 2005 that you would plug in your parameters for which it is to execute. But I know that the bigger hedge funds are huge consumers of data, and probably one of the bigger bigger clients of the AI world, whether it's the microchip industry or et cetera.
So getting back to what you do for your strategy, you mentioned some of the bigger systematic hedge funds. Are there, without naming names, are there bigger systematic hedge funds that you compete with? And if so, how do you stay ahead of them, or how do you set apart what you're doing compared to those kind of bigger competitors?
Yeah, I mean, systematic it's kind of a catch-all term, right? And the industry has started to use it so extensively because of the relative unsuccess of discretionary trading strategies, where investment managers are making decisions on their own based upon data, but there's no predefined methodology for what they're doing. And so the industry in general has developed a strong demand for systematic trading ideas and infrastructures, because people know what they're investing in. People know what they're getting, or at least the idea of what they're getting, because this is what you say the intention of it is and what we'll be doing in the various market environments. Yep. And so, that is the demand for systematic ideas is what was foundational in why we are running our business. and a systematic infrastructure, just because it's an easier sell, right? Because you can say this, I know exactly what I will be doing in these various different market environments, and this is what it will be look like. That's impossible to say that with any degree of confidence with a discretionary strategy. Now, with as far as obviously there are large hedge funds, the multi-strategy funds, they run on a pod infrastructure. They do have systematic trading groups within them. So if the hedge fund has $50 billion, they have 100 different investment pods, which are basically small little hedge funds inside the hedge fund. But I certainly would love to call them competitors, but being that we're a newer fund, we're not in competition with really anybody except for ourselves. And we see the marketplace as an opportunity, not a competitor, just because it's so enormous that there is really enough space for all the good ideas. But the best thing is there's not that many good ideas.
Yeah.
And so if you have a good idea, then the demand will be there.
Yeah, that makes sense. If there was like one thing that you wanted the market, the world, the advisors you talk to, potential clients you talk to, so one thing you would want them to know about Deer Lake, like what's the most important thing would you like to convey to them?
Mostly to convey to just investors, advisors in general, is that you have to have a strong plan and be well capitalized and to execute on your plan. And you need to be able to do what you say you're going to do, both operationally, structurally, and you have to manage your risk appropriately so you can do that. And that is all built upon my entire trading career, and why we're here we are is so we can not only have a very strong plan that has a great potential of making money, but we can do it when we say we would do it.
Yep.
And that's not that easy.
It's extremely complex. The market, the world is very much in flux, and sticking to a plan is clearly a very difficult thing. Coming from the hedge fund world myself, there's this thing called scope creep, right? There's scope creep in everything, but there's scope creep in investing, where people go off the path to try to chase returns or to catch up on because of previous losses and what have you. And the ability to stick to a clear plan is a very valuable thing to do. Assuming the plan is no plan is perfect, but assuming the plan is consistent and well thought out and based on a grounding in the actual data of what happened in the past, right?
And that's you have to. I mean, you only want to stick to your plan if it's a good plan.
Yeah, but goes without saying.
Yeah, exactly. And it's just you to be able to communicate that plan to your stakeholders so they need to. So yes, I don't have a boss or a higher up ahead of me that is going to tell me to close my risk. But if we do have a stakeholder or an investor who they could ultimately pull their investment, and that could still happen. So you need to communicate to them effectively the plan beforehand, so they're fully aware of the goods and the bads. And obviously they don't care about the goods. You're never getting calls from investors when you're making money. But if you're not, and people get scared, it gives everybody a lot of confidence and soothes a lot of nerves. If they knew that, okay, well this was a possibility, and this was laid out to me, in a slide deck of like, this is what it could look like in these moments. It gives them strength to know, it's like, okay, well, this was expected, and it doesn't necessarily need to be acceptable, but they know that we foresaw it as there was an expectation of this happening, and it has happened in the past, that they understand that at least we're doing the right legwork to know the potential market events that could cause losses.
Sounds like transparency is a key to how you manage your business and work with your clients.
Absolutely. Transparency is critical, because it develops trust, and you need trust with you're my co-manager, our other business partners and investors. You all have to, I need to trust them, and you're not taking investor in any business. You're not just going to take investments from anybody. So you need to trust that they're good actors, and they need to trust that you are one as well. And then you can have that success that you all want.
So if someone wanted to find out more about you, what's your website address? How do they find you?
The website address is deerlakestrategic.com, and I'm on LinkedIn, Ross Williams, and but yeah, there's a deerlakestrategic.com. There is some informational pieces that are up there on our blog, and if somebody wants to just have a quick chat, there is a contact form on the website, and they feel free to submit that, and we have a little newsletter we can send out as well, or have a call if anyone wants to talk volatility.
That's fantastic, Ross. It was a pleasure having you on the show. I having come from the background myself in the hedge fund world, what you're doing sounds very exciting, and I want to learn more when we get offline to find out more about what you do. But thank you for your time, and it was a true pleasure.
All right. Thank you very much. I appreciate it.
Thanks.
Bye.
Signing off for Scaling Alpha. Thank you. Bye.